You're the owner of a small business, which means you're also the tech guy, and HR, and personal assistant, and head honcho, and intern. You could use another pair of hands, like the experts you'll find at Verizon Small Business Days, April 21st through 27th. Get a free tech check, special deals, and more. Call 1-800-483-4428 or visit verizon.com/smallbusiness to book your appointment. Verizon Business.
Reality radio for a really great future. We're talking real money.
As the plague continues across the planet or around the planet, we continue to try to focus on one important thing that drives your life. And that, my friend.
Food?
No, is money. How are you going to get the food without the money?
That's a good point.
You don't even run
for about
chickens
18
out
years
there on
without
the farm.
money. I know. I did. The farm. My daughter's got chickens.
I know your daughter does have chickens.
Yeah, I know. She has chickens.
Yeah, and I compare the cost of managing the chickens to the cost of buying a dozen eggs at Walmart, and I just don't see the economic benefit.
I'm with you.
It doesn't pass the monetary good sense test.
I'd rather just go buy those eggs and put them right in the reefer. Pull them out whenever I need them. Don't wait for those chickens.
And they're cheap.
But,
I bought eggs at Walmart recently, like $1.17 a dozen. That's pretty cheap.
Yeah, I don't know even what they run.
So, you don't pay any
chickens
attention.
and money
You
do
go to the
together.
rich people's stores.
Yeah, chickens and money do go together, as you know.
Yeah.
Yeah, because a very well-known NFL star said, y'all take care of your chickens.
That's right. Oh, yeah, I forgot all about that.
All right.
Well, hello. What I was getting to before Tom wanted to bring up food was the fact that you're now listening to Talking Real Money, the show about, well, real money, and you joining us to talk about it as we talk about it, too. You have an inalienable right to call this show at 855-935-TALK every Saturday.
I thought you're...
No, that's your
855-935-TALK. You don't have an inalienable right to money.
No, just to call us.
No.
And talk about it. We give you that right. The Talking Real Money Constitution, First Amendment, whatever.
Guarantees?
You are guaranteed the right to call us for now, today. 855-935-TALK. You can call us 24/7 too, as long as we keep the number active. If we ever shut the number down, your right is denied.
Anything goes money related.
Yeah, you got it.
Not politics, because there's 80,000 of those things out there every day.
A couple of weeks ago.
Yeah.
Not even a couple of weeks. It was about a week ago. Our good friend, Mark Hulbert, wrote an article about financial literacy in America and the shocking lack thereof. I mean, it is shocking lack thereof. There are three questions that a literacy group asks people about money. Three questions. And
what happens if you can answer all three? What happens? You get an egg or a chicken, or
you're apparently smarter than 60% of the two-thirds of the population about money.
Okay.
If you get all three, because only 34% of adults between 38 and 64 got all three right.
All right.
Now, wait, hold on. If you think that's bad, millennials got 16%. Only 16% got all three right.
Yeah, we're going to pick on them anyway. They've got to have somebody
wait. These questions,
beat up.
I'm not going to give you the answers right away. We're going to ask you these. Here's the three questions.
If one of them's what's your favorite color, I'm going to be nervous.
Answer me these questions three.
You saw where I was headed there. Good man.
What is your favorite color?
See, that's the one I always got wrong. What? No blue, no red. God, sorry. Okay.
Dun,
yes.
dun, 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 dun. All right,
We're
here
really
we go.
dating
You ready?
ourselves.
These are three questions.
All right.
Pay attention.
Listening.
All right. Suppose you had $100 in a savings account, and the interest rate was 2% per year. After 5 years, how much money do you think you would have in the account if you left the money to grow? Now, I'm going to tell you, you don't even have to do the math. It's multiple choice. You get to choose your answer. And there's only 3 answers.
I have a question for you, though. First, does my wife know about this money?
I don't know it matters because it's only $100. She's not going to care that much.
Okay.
All right.
I'm just asking.
So after 5 years, you got $100 in a savings account, 2% per year. 5 years later, how much money do you have? Here are your answers. A, more than $102.
Okay.
B, exactly $102. Or C, less than $102. Okay.
I had my hand up for a long time, by the way.
Yeah, you can't answer it yet.
So you know.
We're going to do it. We're going to do this after the break. Actually, we're going to do the rest of the questions after the break. Well, that break got here fast, didn't it?
Well, we're monkeying around about chickens and eggs.
So here's what I want you to do. I want you to ponder that question because I know that was a toughie. So you think of your answer.
And if you can't answer that, think about the quest or the color. One of those two will ask.
Then we have 2 more questions for you. 855-935-TALK.
Tom and Don are talking real money.
Everybody needs help with their money now and again, and if you need more help than we can give in the course of this podcast or show, set up an appointment with one of our advisors for a free actual meeting with no obligation and no high-pressure sales pitch. Just go to vestory.com, that's vestory.com, or call 800-386-3004.
For your real life and real future, Tom and Don are talking real money.
Hello again. Welcome back to our little get-together called Talking Real Money, the show that talks about real money. Hi, I'm Don McDonald. Over there's Tom Cock. We are sharing some questions on financial literacy. And the second question, I know you pondered that first one. We're not going to give you the answers yet. We got a little game going on here, so pay attention. All right. Imagine that the interest rate on your savings account was 1% per year, okay? Got it? 1% per year on your savings account. You don't even have to imagine. You'd be lucky if you got that. And inflation was 2% per year.
Sound familiar, by the way? Go ahead.
After 1 year, how much would you be able to buy with the money in this account? How much would you be able to buy? Answers. More than today, exactly the same, or less than today? Okay, that's question 2.
Yes.
I'm going to give question 1 again, just for everybody, because we got a little contest going. Paying attention? Okay. This is the last one. Buying a single company stock. I'm doing this slowly so you get the point. Buying a single company stock usually provides a safer return than a stock mutual fund. You only have 2 answers to this one. True or false?
Single stock versus stock mutual fund.
Which usually provides a safer return. And again, the first question.
Safer.
$100 in a savings account at 2% per year. After 5 years, how much would you have if you left it? More than 102, exactly 102, less than 102. You now have your 3 questions. Here is your challenge. The first person to call with 3 correct answers. Tom is going to provide you with $25 worth of stuff at Starbucks. At 855
and it's here, by the way. It's right inside my... Yeah, go ahead. Give the number again.
855-935-TALK. 855.
Yeah, and it's in my... You have to come here. It's in my kitchen right there.
Actually,
come by.
He's got one of those Starbucks coffee makers. So he's just going to pour you like 5 cups of coffee.
Pick up some furniture while you're here.
No, he's going to give you
stuff. No, we're actually going to give you a gift certificate. But while we're waiting, I'm going to ask you.
Apparently, nobody knows. No, I'm going to be really disappointed if our audience doesn't know the answers to those questions.
Call. Okay,
go ahead.
I'm going to ask you a question.
Okay.
If the stock you own went up 5% a year, how much are you making? Well, if the stock you own went up 5% a year, how much are you making?
How much am I making or have made?
Yeah. I think that's what I said. How much are you making?
So if it has gone up 5%,
yes,
in the past year, I have made 5%.
Yeah. How much are you making?
I have made 5%.
Come on, man. You're not making anything.
I know, because it's future tense.
Thank you.
Future
but
tense.
People say that all the time. Hey, I'm making 5% in the market. No, you're not. You're not. Okay, let me just finish this before we go to the calls.
Okay.
You're only going to making money if it's in a savings account or if you own a bond or some sort of security that's paying you interest. When you put it in stocks, you're not making anything. Number one, it's always past tense. Number two, nobody has any idea what stocks will make in the future. So please do not use that term. That drives me up a tree.
It's a Tom pet peeve of the day on Talking Real Money. All right. So we do have a contestant in our financial literacy quiz.
Step in.
Moira, welcome to Talking Real Money. And are you ready for your questions again?
Sure.
All right, Moira, here's the first question. You have $100 in a savings account. Interest rate is 2% per year. After 5 years, are you going to have more than 102, exactly 102, or less than 102, and you're out of lifelines?
I'm going to have more than 102.
Really?
All right.
Wow. And we have no sound effects to go with that.
I know. I was going to try to find a horn or something. Right? I go get the dog to bark, maybe.
Yeah, no. You can't get the dog to bark when you want the dog to bark. The dog only barks when you don't want the dog to bark. All right, next question. You're earning 1% per year on your savings account. Inflation is 2% per year. After a year, would you be able to buy more than today, exactly the same, or less than today?
So, okay, this is a little confusing, but I think...
All right, let me give it to you again. Let me give it to you again. Okay. I'll give you a chance. Hold on. You have a savings account that pays 1% per year, and inflation is 2%. After 1 year, how much will you be able to buy with the money in this account? More than today, exactly the same, or less than today?
I would say less than today.
Correct on 2. Finally, the final question with all the money on the line. With the whole $25 of...
Hey, what? $25.
Hey, all right, here we go. Buying a single company stock usually provides a safer return than a stock mutual fund. True or false?
False.
We have our winner.
Ding, 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 ding. Wait, I got to ask her one more question.
Okay, here you go. And this one doesn't count.
You
already won.
No, what's her favorite color? We should have asked that first.
Green.
Money.
Right.
Green.
All right, and she has the right answer again.
Wow,
you're really on it.
You get a gold star on your gift card. Tom's going to throw one on.
In
there
all
for
seriousness, Moira, thank you for calling and playing along. And Stacy back or Kelly at the station, if you could get your phone number, we'll call you and we'll get the certificate to you. So
yeah, thank you for playing.
That was very kind of you. Good answers, by the way. So you just separated yourself from what, 2/3 of America? Is that what you said?
Exactly. Only 34% of adults over 30, I think 6 or whatever. Only 34% of adults got all 3 of those correct. Only
let's talk about them.
4%.
Well, let's talk about them. First one was which one? I forget. I don't have them in order here.
Oh, I do. The first one was, well, come on, they're too easy. $100 in a savings account at 2% per year. You can have more money or less in 5 years.
So at the end of the year, you're going to have $102.
Right. The end of 2 years, you're going to have $102 and
plus
you're going to have $104.20, et cetera. I'm not doing the math.
Okay. I think I got that one figured.
I'm sucking down some Chick-fil-A
It was
iced
the
tea.
next one that she was wondering about.
Right. Well, that's inflation.
At 1%, and then inflation is increasing the prices by 2. Mm-hmm. So if the savings is only increasing by 1, but the price of everything's going up by 2, you can't buy as much.
So you have a $100 item right now, and you earn 1%. So at the end of the year, you're going to have $101, but inflation caused that item to go to $102.
Yeah. So you get less. And by the way, this is the reason I said sounds very familiar, because that's basically the situation we're in today. Mm-hmm. I think we talked last week about the fact that savings rate today, typical savings accounts about 0.6% a year.
And
inflation is running. It's somewhere about that's what it said in the journal. And inflation is running somewhere between 1.5% and 2%, somewhere in that area. So the people, those of you listening, the $13 trillion of you that have it in savings, yes, you are losing out every day to rising prices for reasons that I struggle to understand, other than you feel good because the same amount of money's there every day. which
Right,
makes
it's
you feel good,
psychological.
but
It's a game we play with our brains.
crazy. And then one stock versus a stock mutual fund. If you own more of something, you're diversified. That's less risky than just having it all in, even if it starts with VAX, which we'll talk about in a minute.
855-935-TALK. Give us a call. You have some questions about money? You want to become more financially literate? You want to enjoy a better future? You need to call.
Tom and Don are talking real money.
There's a science to managing money. I call it financial physics, and you can get a free copy of my easy-to-read book, Financial Physics, at talkingrealmoney.com/free, or there's an interactive version available on Apple iBooks. It's called Financial Physics. That's spelled with an F, and you can get it free at talkingrealmoney.com/free or in the Apple bookstore.
Your guides to a really great financial future. Tom and Don are talking real money.
I just checked, and according to the FDIC from just a few days ago, the average
I'm making you more money.
interest rate on savings accounts in the United States of America is 0.05%. 5/100ths of 1%.
Yeah, 5, what we call in the business, basis points.
5/100ths of 1%.
So it's worse than I stated. And by the way, the number I had was from the Wall Street Journal a week ago. So
yeah,
maybe
and
things
that
really
may have
gone
been
down
including
since
short.
then.
That could have been including treasuries or.
It's not much.
It's not much.
There's no reason, by the way, to hold cash other than you're waiting for the price of something to go down to buy it, or you're going to buy something tomorrow.
Or it's for emergencies.
Yeah, but even then, we could get into an argument again about owning short-term bonds, but.
Right,
which,
but you
by
keep
the way,
it,
are up 4%
and by the way,
this
the
year.
average interest rate as of October 2020, according to Bankrate, on money market accounts is 0.11.
Wow. So I wonder where this journal came up with that
where
number.
they got that
I
number.
don't know. So,
855-935-TALK. Call. We'll talk about money with you and about anything that has to do with money. Sam, you're up. Welcome to the show.
Hi, thank you. Hey, I called last week, and my question to you was comparing ETF like Index 500 to the regular mutual fund 500. But my the question I wasn't able to ask is, does the ETF celebrate dividends and capital gains?
The ETFs do pay dividends, but they don't realize capital gains.
it's an important differentiation, by the way, because if you're tax sensitive, then owning an exchange traded fund does make more sense. They sort of push them out. The way they're designed is designed to be more tax efficient. So you don't pay capital gains tax. I mean, or pardon me, or any of those things, right? They push forward. I'm forgetting the other thing. You don't have to pay tax on, but they are better in terms of being in a taxable environment than a mutual fund, but only if your tax rate is of a certain level too.
And here's the deal with
start getting specific.
Mutual funds, actively managed mutual funds, are going to realize lots and lots of gains. So they're going to they have to distribute those in the year they earned them. Even a passive fund, though, occasionally will realize capital gains and have to distribute that in the year they earned them. ETFs never realize capital gains. The capital gains are only realized when the owner of the ETF sells the ETF.
Okay. Can I ask one more question?
Sure.
Please do.
Tax related. When you make over a certain amount of money, like over $85,000, for instance, your Medicare goes up. Is your Social Security even supposedly it's taxed at 85%? Correct? Social Security.
Yes, Social Security gets taxed at an 85% of the benefit, but it doesn't kick in until, and I don't remember what the number is.
I forget the number. You got to make a certain amount before that becomes relevant.
But does the total amount of Social Security play into your gross income? Not
for calculating. Okay, here I got the latest. If you earn outside of Social Security between $25,000 and $34,000, 50% of your Social Security benefit is taxable at your income rate. If you earn more than $34,000 from outside of Social Security, employment income, taxable income, then you're taxed at 85% of your benefits. That's the latest from the Social Security Administration.
But is the total amount of Social Security calculated when, like, for Medicare. Do you know that question possibly? Do you understand?
Are you saying is Social Security calculated for whether or not you're paying on Medicare?
Well, no, because if you hit, even though, okay, let's say you make $10,000 in Social Security and I'm taxed at $8,500, correct? But does the whole amount of $10,000 plus all my dividends and interest go to my calculation to pay Medicare? Whereas only
my understanding is that it is the portion of the Social Security benefits that is taxable, but I'm not a tax person. That's what I've read is that, for example, if 50% of your Social Security benefit is taxable, you add that to your non-taxable interest and the like, that comes up to be, I think they call it combined income or something, and I think that's what they're talking about, but I'm not an accountant, so don't hold me to it.
And by the way, it's another reason to, if you're still making money, to delay Social Security. That's what I was trying to get.
Tom and Don are talking real money.
If you don't have a financial plan, well, sometimes you just need a little help getting started. And we offer that free help to anybody in a meeting with one of our fiduciary advisors. To set one up, just go to vestory.com, vestory.com, or call 800-386-3004. There's no obligation, no cost, and I promise, no sales pitch.
Reality radio for a really great future. We're talking real money.
Hey there, welcome back to the program. I'm Don McDonald, along with my good friend and longtime co-host, co-worker, co-annoyer, Tom Cock. 855-935-TALK is our number. Man, suddenly I just forgot what I was saying. 855-935-8255. Give us a call. We'll talk about a lot of stuff money-oriented and things that bother us, like Tom is bothered by people saying, you know, I'm making blank. Yeah, it bothers him. What bothers me is when the Motley Fool makes some sort of a pronouncement, like, and they do it. I know it's just clickbait. I know it's clickbait, but it bothers me so much. You know, the one stock you should own today or whatever, well, like this one. The one... Get this. The one must-have investment if you're worried about a stock market crash. Now, you are going to want to click all over that, aren't you?
Everybody is, because everybody's always worried about a stock market crash, because that means your money, I guess, is gone somehow. It's not coming back. It's crashed, which is silly. But, yeah, you want to know that thing you got to have to avoid the crash. Sure.
And you're going to think, wow, this is something really esoteric and special, and I bet nobody knows about this but the Motley Fool and soon me.
Woo-hoo. Those Gardner brothers have been down in the lab coming up with the next best thing.
So, of course, Don clicked on it so you don't have to. Because I do that. I click on those things. Here's the one investment. The one, like it's the only one. Quote, the one investment that will give your savings the best shot at recovering from even the worst market downturn. Are you ready, ladies and gentlemen?
Please do.
The S&P 500?
An index fund?
The S&P 500 index fund?
The Gardner brothers, who said mutual funds were bad, said you shouldn't own those, just buy the stocks that you know, the companies that only go up. Why would you own an index fund?
Well, apparently because it does, as they show in their fancy chart, even after a big decline like 2008, it's tended to go back up. What their chart does not show, which is really fascinating, because they start their chart in 2007. I wish they'd started their chart in 2000. If they'd started their chart in 2000, it would have painted a very, very different picture, because you would have seen that where you started in 2000 was actually higher than where you ended at the beginning of 2010.
Yeah, you had a decade of, I think they called it the lost decade for the Standard & Poor's 500.
With dividends reinvested, over 10 years, the S&P 500 lost almost 1% per year, just under 1% per year. Now, without the dividends, if you had spent those dividends, you would have been down over 3% per year.
Would have been horrible. So yeah, I love what they're saying. The reason you own the S&P 500. This has, by the way, diversification. That's what they're saying. Instant diversification.
That's what they're saying.
That will not necessarily save you from a stock market crash.
Nope.
There are times when all stocks go down. They've done it, right? 2008 wasn't that long ago. There's other periods, 73, 74, for those of us old enough to remember the early 1970s. So it's a silly thing to say. And instant diversification, frankly, just owning the S&P 500, as we've talked about many times on this program and many other places, is not nearly the diversification you should have.
Because what we forget is that while it is 500 stocks, of those 500 stocks, 7% of your portfolio is one single company. One company is 7% of your entire investment. Two companies make up over 13% of your total investment. Three companies make up 19% of your total investment. Three companies. Four companies make up over 21% of your total investment. And five companies make up over 25% of your total investment.
Now you're talking about the FAMA stocks, formerly known as the FANG stocks.
Yeah, because Netflix got kicked out of that list. The alphabets took over. The alphabet.
So you still got Microsoft in there. You still got Amazon in there.
What's the one that's 7%?
That's got to be Apple.
And what's the one that's second? Microsoft.
Amazon?
Microsoft.
It's hard to keep track of.
But that's 25%. That's not.
Those stocks have made 49% this year. You wanted to be in them, but not to the extent that you are in the Standard & Poor's 500.
Tom and Don are talking real money.
Before you end up buying a financial product that you'll regret later, either call us on the podcast or the show, or if you need a little more time, that's why we offer free meetings with our fiduciary advisors at Vestory with no cost, no obligation, and no high-pressure sales pitch, I promise. Just give us a call at 800-386-3004, or better yet, just set up an appointment at vestory.com, VESTORY.com.
For your real life and real future, Tom and Don are talking real money.
So, if you're confused about investing, you probably could use a little help. That's why we're here. Give us a call at 855-935-TALK. I'm Don, that's Tom. This is Talking Real Money. Before the break, we were talking about the Motley Fool's ridiculous claims that something like the S&P 500 is the way to save yourself from a market crash. Well, we believe in a diversified portfolio and its ability to make a decline more comfortable. But that is... Their approach is, we think investing simple. Theirs is just ridiculously simplistic. It's stupidly simplistic. It is not that simple. You need to have a plan for your tolerance for risk and need to take.
Yeah, and I think the part that, in addition to, the idea that you could hold a wide basket of stocks that would protect you from a crash has been incorrect several times, right? Just mentioned that. But if you wanted to give yourself a little additional protection in the stocks you own, you just diversify more. The Standard & Poor's 500 is 500 out of about 4,000 or 5,000 publicly traded companies in the country. Mm-hmm. So you'd add all those in. Those are smaller companies in value, et cetera. And here's the part that I think I mentioned on a podcast this weekend. You want to own international stocks. Yes. Please keep calling us and telling me why it's a bad idea, because I'm going to tell you you're wrong many ways over.
That podcast will air tomorrow.
Thank you. The reality has been in longer periods of time, not the last 10 years. I know we all suffer from recency bias. Mm-hmm. But over long periods of time, you've actually made a little bit more. You've reduced your volatility. And frankly, just intuitively, your risk has to be lower by owning more of something than less.
And let me give you some numbers to back that point up. Using a portfolio very, very similar to what you just talked about, large company stocks, small company stocks, value stocks, and split half U.S., half international. If you had owned that kind of a portfolio between January 1, 2000 and December 31, 2009, 10 years, you would have lost about 1% per year with the S&P 500. You would have gained over 6% per year with a diversified portfolio.
And yes, we already know the last 10 years has looked different. What do I expect in the future? I have no idea, but I will tell you this, and I share this on the podcast, so I don't want to spend too much time on it. There have been countries where you've invested in that country, and people do have a home bias. They put most of their money in their country because they live there, they know it, et cetera, et cetera. Japan, 30 years, you're still down by about a third if you held the Nikkei over 30 years. Not saying it'll happen here. I have no idea, but that's just, to me, a reason why to spread your money around, because sometimes countries do great and sometimes they don't. By the way, Japan from 1970 through right up till 1990 had a terrific return. And it looked like, and for those of us old enough to remember, it was all about Japan at that point. So, no, be diversified.
And we're
own a lot of
definitely
countries.
old enough to remember that.
Yeah, exactly. Thank you. So, I mean, I would just be more diversified based on that, if for no other reason. And the fact that about half of the value of stocks is outside the U.S., about half is inside. You're just spreading it around to where those companies are. That's the way and I would never trust, if you're not okay with seeing half of your money go away, I would never trust having it all in stocks. I mean, that's what this is suggesting, right? That's what this article is telling you.
That's what it's suggesting.
You're diversifying into the S&P 500. Is that better than just being in one stock? Sure. But is it going to protect you from a stock market crash? Absolutely not. Would not do it. Has not done.
And by the way, just to carry that statement about how having the international stocks for the lost decade would have saved you, and the fact that internationals now have done poorly over the past 10 years, still, the average annual return over that 20-year period through today, almost 20 years, is right around 7%.
There you go.
Which is this is why we say it's okay to be average. Wouldn't it be nice to just sit back and go, okay, I'm happy my portfolio is making about 7% a year. That's good. I'm going to settle for that. That's what the market gives me. I'm good with that.
It's not exciting. There's not much romance in it, right? We can't get you excited about that because soon we'll talk about stocks that have made 4,000%.
No, we won't. It is not soon.
Okay.
See, Tom's assuming that this podcast.
Pardon me.
You can't promote the next hour of the podcast.
Sorry about that.
Okay, so those of you listening to the podcast, you'll hear that tomorrow.
In the future. Okay, sometime in the future. And that's why people think that investing is finding the new exciting hot thing. All you got to do, here's a little preview. Just add Vax to the end of your name, and you're going to make a lot of money this year.
You used it again, didn't you?
That's not investing. That really is speculating. Investing, and very famous person once said, should be as exciting as watching your grass grow, as exciting as watching the paint dry, and over time, making enough to stay well ahead of inflation. Hey, that's what it should be.
Here's another interesting number. I mentioned that if you owned a diversified portfolio from January 1, 2000 through the end of September 2020, you would have made about 7% per year, globally diversified. This is not an actual investment. This is looking back at some numbers. But anyway, if you had owned the S&P 500, now that's the one that's been so hot the last 10 years. If you own the S&P 500 from January 1, 2000 until September 30th, 2020, what do you think you would have made a year, Tom? You always ask me this.
I'll say it's like 5%.
6%.
Okay, yeah.
So look at that. Less. You would have actually made less with the S&P 500 than with a globally diversified portfolio. But the interesting thing is, if we measure risk by a thing called standard deviation, which is basically volatility, the volatility of that portfolio over that almost 20 years was 15%, whereas the average standard deviation for the international is going to be similar and gives you another % return.
And people
would have given you, I should say.
Given you, thank you. People do forget 1% a year difference That's a big deal
And
over the long
by the way,
haul.
that would be after.
It doesn't feel exciting.
That would be after if we had fees. I take that out all the time.
Oh, okay. So yeah, so if you add in 9, right?
But here's what the point I wanted to make: the S&P 500 made 6% per year over that 20 years, almost 20 years. A globally diversified, balanced portfolio, 60% stocks, 40% bonds, made 5.5% over that 20-year period, with 50% less volatility.
Which, for most people, is very important because, again, think back if you own stocks, how you felt in late March. You were scared. The markets had gone down precipitously in a very short period of time. Or does precipitous mean? The bottom line is it went down fast, and people were scared. I was talking to a lot of you on the. What are we going to get, et cetera?
Use torrentially.
Now, luckily, it's torrential. Thank you. So that is a big deal because really, what you want to be able to do is make some money and sleep well at night, not worrying about all the things you can. COVID, presidential elections, et cetera. All those things that are out there that are driving stock prices that we really, at the end of the day, don't understand exactly what's moving the market. But you don't want to worry about those things.
The ultimate point of all this is that instead of the S&P 500 diversification, you need real diversification, massive diversification. You need to base it on your risk tolerance and your risk need. And once you build this massively diversified portfolio, the trick is just staying with it and rebalancing it. You're done. 855-935-TALK. Call anytime.
Tom and Don are talking real money.
Everybody needs help with their money now and again, and if you need more help than we can give in the course of this podcast or show, set up an appointment with one of our advisors for a free actual meeting with no obligation and no high-pressure sales pitch. Just go to vestory.com, that's vestory.com, or call 800-386-3004.
Your guides to a really great financial future. Tom and Don are talking real money.
You know, we're always giving away educational stuff free, like this show and the Real Investing Journal, stuff like that. But, you know, you can get free copies of some of the books that and booklets we've created at vestory.com. Just go to the front page. You'll find our free books. There's you can download a copy of Financial Physics for free. You can download a copy of the Better Retirement Guidebook for free. Other stuff there. Oh, by the way, you can also get Financial Physics for free in the Apple bookstore, and it's a really cool version of it. So if you have Apple, check that out. So go to vestory.com, get your free books.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestory, a fee-only registered investment advisor. Thanks for listening, and please visit talkingrealmoney.com for more information and disclosures. That's a wrap.